Views expressed by Camaplan podcast guests may not reflect those of Camaplan. Camaplan does not guarantee the accuracy of information provided by guests, nor does it endorse or recommend any individual or organization. Camaplan is not an investment advisor, CPA, realtor, or attorney. You are encouraged to conduct your own due diligence before making investment choices. For any tax, legal, accounting, investment, or other questions, please consult a specialist. Hi, I'm Michael Duncan, and welcome back to The Road to Financial Freedom. This podcast is brought to you by Camaplan, a self-directed IRA administrator focused on educating investors on how to grow retirement savings faster through alternative investments. In each episode, we're going to take an in-depth look at the many roads taken to financial freedom and how they differ for each of our guests. Our goal is to help the listeners learn how they can achieve their own financial freedom through the experience and stories of experts that have done just that. Today's guest is a managing partner of One Street Capital, a private equity real estate firm focused on acquiring real estate assets in growth markets across the country. She began working within the real estate industry over 20 years ago through several tax and accounting engagements with real estate clients while employed at a CPA firm. She has also invested in a variety of real estate and other alternative investment asset classes as both an active and passive investor. I'm very excited to welcome Denise Piazza to the show. Denise, how are you doing?
I'm great. Thank you. How are you?
I'm doing well. You know, we're recording this on a Friday, a little peek behind the curtain. So, you know, I think we're both ready for the weekend, ready for it to get warmer, honestly.
Yes.
But I'm really excited to talk to you. I was introduced to you by a coworker. You'd recently had an article published on Camaplan's site. So that's actually the first thing I would love to ask you about. Just, I guess, for listeners who haven't read it, give them a reason to go and read it. It's called 50 Questions to Ask Before Investing in Real Estate. Could you just tell me a little bit about that article?
Yeah, absolutely. So I come from a background of years and years of passively investing in real estate assets. My husband and I are both CPAs, and so that pretty much means our kids have no chance of being cool whatsoever. But it also means that we started to get into real estate right after we had been preparing for a lot of tax returns for a lot of high net worth clients, and saw that a common theme across those returns were real estate holdings and real estate investments. So we began investing, I'd say over, 10 years ago, at least now, once we built up a little bit more liquidity. And we, invested in a lot of different asset classes. We did some single families, triple net lease, multifamily, and we even bought some office space. So, along the road, we had a lot of great experiences and then some not so great experiences. So I wrote the article really from the perspective of things that I wish I would have asked along in my earlier years of passively investing, and really with the intent to help people do a better job of due diligence before placing their hard-earned money into any sort of investment. More recently, I've done a lot of real estate syndications, and I have, taken what I've learned from those experiences and, put several questions together about what you should ask someone before you go ahead and make that investment.
So not exactly a Cliff Notes, but more of a trailer, let's say, for a blockbuster movie. What are the must-ask questions? Obviously, there's 50, and I think they're all very important.
Yeah.
But if you could pick maybe a top 3, the ones that you would most focus, if you had 5 minutes before you had to make this decision, what questions would you ask?
Sure. I'd say, why did you select that market? What do you like about that particular market and attracts you to making an investment there? I'd also ask about some of the key assumptions associated with that real estate deal. So what's the debt structure look like? what are the what does the return structure look like? Is there a preferred return? Meaning, do the limited partners or passive investors get paid before a certain amount before the sponsor to the deal makes any money? I'd also ask a lot about the team. So, I think that's an area that also gets overlooked. So my main criteria for the team would be, what's your background? Do they have a successful business background? How many partners are involved? Are they personally investing in the deal themselves? And then lastly, what's their track record in this area and this particular aspect of real estate investing, so you can feel comfortable that you're placing your hard-earned dollars in with the right team.
I think that makes a lot of sense. I think, from what I've seen and from what I've learned, as I'm getting into this world of investing and passive investing, the people you work with seem to be by far the most important. And I really like the way you kind of broke that down of, asking about their background, asking how many and, are they investing? Because why would you want to invest in something that the people that are managing it, I guess, don't believe in enough to invest in? I think
Right.
that's a really, really important question to ask.
Right. You want to make sure your interests are aligned before you're getting into any investment opportunity. So are they incentivized to, do a great job in performing the business and executing the business plan? And again, to going back to that preferred return, which we can talk a little bit more about, but that preferred return really is, until they make a certain return hurdle, they would have to essentially work for free.
Yeah.
So they would be, not getting paid anything until the investment makes, let's just say the preferred return is 10%. They get nothing until the limited partners make 10% on the deal.
I like that. So in terms of the market, there was a couple things you mentioned about the questions you would ask about the market. What kind of answers are you hoping to hear back from the person? Because obviously knowing what question to ask is important, but also knowing what answer you're hoping to hear is
Right.
important as well. So what kind
Absolutely.
of things are you looking for there?
Yeah, we have a few criteria that we look for. The first of which is the area you're investing in, is it landlord friendly? Because, we've all experienced the past few years, especially, there was a lot of legislation out there that allowed folks, because of COVID, it allowed folks, there was an eviction moratorium, and it allowed individuals from a real estate housing perspective to not have to pay their rent and to be able to apply for assistance, which is great to a certain extent. But if someone's not paying their bills, not getting the appropriate assistance that's offered to them, and basically not doing what they're contractually supposed to do, you want to make sure that you have the power to evict them out of your property so that you can, make sure you're maximizing your investment. And you want to limit that, that delinquency that you'd experience. The other big thing that we look for is population growth. I look for, are people moving into that market? If people are moving to that market over the last several years, population growth is what ultimately fuels the ability to be able to resell your property, whatever your business plan is, whatever you're doing, whatever type of asset you have. If people are moving into a particular area, it's just the demand for real estate in that area is going to naturally increase with that population growth. Another thing that I consider is job growth and wage growth. So are companies expanding in that market? Are companies, incentivizing their employees to be to work for that company in that area? Are they building any new plants? You want to make sure that in addition to the prosperity of the company, you also want to make sure that there's not one dominant industry that could essentially take out the entire local economy. So you want to make sure that there's employment diversification across various industries. So those are some of the few key things that we look for when we're looking at real estate investment opportunities.
That's really interesting. Especially that the note about having, in particular, one key industry that might be able to take out that entire area. Just out of curiosity, would you happen to have an example for the listeners? Because that really intrigued me. That's not something I'd heard before.
Yeah. So when I first started investing, one of my investments is in Houston, Texas. And when people first think about the city of Houston, they assume that it's all oil and gas driven
Hmm.
economy. So one way, and there's a lot of different resources that you can use to actually see what that employment industry breakdown is. There's a few free ones that are actually available, like niche.com. There's Neighborhood Scout, which is another great resource for being able to look at the employment diversification in that particular area. But one thing that became really interesting to me is I assumed that it was all oil and gas industry driven. And I saw that there was actually a percentage that was less than, which is sort of our threshold for any one industry to be less than 25-ish% of employment, 25 to, I'd say, 40% of it, 35 or 30% of employment. We look to be below that. And when I looked at the actual number of jobs in Houston that were dependent upon oil and gas, it was much less than that. So that gave me an additional level of comfort that, if people, if there was issues with that particular industry, that not all of our tenants and residents would be losing their jobs and not able to pay their rent.
That's really interesting. That's something that seems obvious once you said it out loud.
Mm-hmm.
And the more that you talk about it, the more sense it makes. But it's not something I ever would have assumed. It's not
Yeah.
something I would have thought of, which is also why I'm not doing your job. There's a very good reason for that, obviously. Um, so the other thing would be, so you mentioned that word again, assumption. You
Mhm.
assumed about the Houston and the oil market there. What other key assumptions would you want to hear about when you're asking these questions?
So, a lot of the key assumptions that you really need to understand and know what the team did in order to determine those key assumptions is around the deal itself. So, there's a few inherent assumptions that get put into pro forma that really, if those key assumptions are too aggressive, um, in my opinion, the projections are ultimately pretty meaningless because they're just simply too aggressive. So
Hmm.
one example would be what are you ultimately going to sell the property for? What's your exit strategy? What's your assumed valuation upon exit? And how did you get to that assumption? So there's a lot of, different sources that we look at to what I like to say, trust, but verify. So some of them are, our resources that we pay for, software subscriptions that we use to determine those key assumptions. And then others are just basic math skills and projection skills that I've acquired along the year, throughout the years of with my background. And then the other big one that we take a look at is what is the debt structure associated with the acquisition. So if the loan to the total value is too high of a percentage, so how much they're essentially borrowing associated with that particular property, that's a red flag for me. Right now, with where interest rates are, we've seen the loan to value on properties and investments that we've put our funds into at a smaller proportion, smaller percentage than what we had in the past when interest rates were a lot, were much more favorable. So we've seen those loan to values come down to 60 to 65% of properties, just, speaking more recently in deals that we've looked at.
Okay, that's awesome. Thank you. That's a great answer. So getting back to I guess the basic of real estate and investing in real estate and trying to make a living, make money doing this. You mentioned to me that you have three pillars to invest intelligently in real estate. Would you mind sharing them with me?
Absolutely. So the three pillars I sort of alluded to in a previous answer, but like going into a little bit more detail, the three pillars that I consider are the market itself, that being the first, the deal itself, and then the team of individuals that are actually, executing the business plan for the investment. The first market pillar is a lot of the things that we've discussed. So I look for areas that are strong growth markets that fulfill our very stringent investing criteria. So it goes back to that whole concept of the population growth, the job growth in that area. Is there a lot of crime? Is there good schools within the surrounding areas? Because all of these items make that property more valuable. So, that is going to completely help you when you're trying to increase the appreciation and the value of that property. So that's really the market that resources that I look at, and then the deal itself is the second pillar. And, when I first started buying real estate and investing in real estate, I immediately focused on the returns. So, having a financial background, I would skip right to the page that said like, okay, well, how much money am I going to make by investing in this?
Fair enough. Yeah.
And which a lot of people do.
Yeah.
And although that's very important, what you need to do is you need to trust but verify. Like I said, and you need to make sure that you're doing your due diligence before you're investing in anything, basically. You need to focus on the debt structure. Many new investors only review, the return structure, as I said. And the reality is that most of the less attractive investments that have taken place, even through the great financial crisis, will have very aggressive debt structures.
Mm-hmm.
So that's a key metric that I mentioned I look at. The preferred return is another one that we mentioned. It aligns the interest of the people who are running the asset and executing the business plan with your investors, so that the investors get a preferred distribution of cash flows. And I also, stress test some of the key assumptions that go into the overall investment itself. So what are their rent projections? What are their refinance assumptions, if there are any? You really want to look to the reliability of the information that's within the financial projections, because, as I said, if they're too aggressive, it pretty much makes the projections in pro forma meaningless. And the last of the three pillars that we consider is the team itself. So it's one that often gets overlooked. Like I said, myself included, when I first started investing, I would strictly focus on the returns that are available. But I think it's really key to consider aspects of the team that's sponsoring the investment. So how many partners are there? Do they have a successful background? How do they communicate with investors? And I often request a sample communication so I know exactly what I'm in for. What's their investor retention rate? So, how many investors that have invested in previous deals are still investing with them? What fees are they charging? And then also, it's one that seems so simple, but people often don't do, is just to ask to talk to another investor that they have. Odds are that they're going to give you someone who's happy with their performance, but still, it gives you an opportunity to ask your own independent questions of them and make sure that you feel comfortable in speaking with another person who's invested with them in the past. And I think the team, this one, it's difficult to gauge sometimes. So you really have to take your time and get used to, that team and develop a relationship, because the one thing about the market that we've been in the last decade or so, a little bit more than a decade now, is that it's been really easy with all the compression of the cap rates that are out there and the incredibly high valuations that have been out there in the real estate world. It's been easier for someone to be able to, make money on these investments without
Yeah.
having to do too much, because, in some of the markets, at least that we've invested in, the appreciation was just exponential when, debt rates were so low. So it's just been one thing that you have to be careful of is not relying too much on, well, what did this particular person do in the past?
Yeah.
Because they might have not done much and not been able to execute their business plan, but able to still make a decent return for their investors. That's another reason why I think talking to an investor and really trying to figure out, were they able to meet what the projections they said they were going to meet? Were they able to, if they're, doing construction or renovation to a property, were they able to do it timely? Things of that nature. Those are things that you can ask another person who invested in prior deals.
Yeah. I mean, it sounds like you're really just trying to get a good idea of who you're working with, which
Absolutely.
again seems very, very obvious, but is not something that people always tend to do.
Right.
So something I love asking my guests about, because I think it's something that's really important, particularly as just something that you can use to learn, is your failures. The good, the bad, the ugly experiences that you've had, both in real estate and as a passive investor. And I was wondering if you could share some of those with me and the listeners.
Yeah, I totally agree with you. I think the failures that you have and the issues you encounter make you a much more well-rounded person,
Absolutely.
make you stronger and a lot more wise. So I'd say, one of my biggest just failures and overall disappointments in the real estate world was in an experience early on in investing that not trying to get to know the team before I made an investment. I knew I wanted to invest in a certain type of property. I knew that, I knew I thought I knew the person that was, was executing the business plan. I knew their background, didn't know them personally, but knew their background. And I didn't really notice that the type of investment that they were pursuing, the type of property that they were pursuing, and it was a triple net, but they were doing a lot of work on this property. And it was a property that it was a type of work that they had never performed before. They had made some, light changes, I'd say, and improvements to previous properties, but they had never done a full gut renovation in the past. And so that experience did not go well. And not only that, but it didn't go well, but not only that, but there was zero communication about it. For all we knew, everything was going swimmingly. They would send out a monthly report, but it meant the information was truthfully very confusing and, it was not very forthcoming. So my own personal take is to always be completely upfront with people. I think that you need to let people know where everything stands, the good, the bad, and the ugly, like you said.
Yeah.
It's better to be honest and put everything up front. And so know what the game plan is and how you're going to remedy it. So I'd say that's one of my biggest learning lessons. And then the other that I always tell people about is, not even just with real estate, with alternative assets or with the market, is just know before you start investing, know what your investment goals are and take ownership over your investments. So, first when I first started working, I was just putting money into my 401k and not taking as much ownership over what I was investing in. And I would kind of leave it to, advisors or whomever to take more control. And then, the other thing is just not knowing what your investing goals are. Do you want more cash flow? Do you want more yield? Or do you care more about your overall velocity of your capital? Meaning, how quickly you can invest in something and then get your capital back and accumulate more wealth. Do you prefer the other thing that I knew that I wanted was tax advantaged investments, but I also didn't know how each of the real estate investment asset classes behave. So I didn't know how that would help me ultimately, marry my tax advantage goals with how it meant what it meant towards, realizing enough cash flow and wealth accumulation at the same time. So it's really taking the time. I think that's one thing I learned is before you do anything, you should really know what your investment goals are.
Yeah, I'm a firm believer that you learn more from failing than you do from succeeding. Because you know that there's something you need to improve on and there's something you need to do better for next time. And I can tell that you feel the same way, because before I even asked you about your biggest failures or the biggest things that you've learned from your mistakes, you talked a lot about the team, the people you're working with. And then, as soon as you were free to talk about your mistakes, the first thing you said was, I worked with these people that didn't communicate, that weren't helpful, that weren't upfront. And it's very clear to me that you learned a lot from that experience. And I think that's the most important thing, especially in an industry like this. And so you did sort of start to touch on this at the end of your previous answer, but what are your favorite avenues to build tax-free wealth? Whether that be real estate or, something else, but obviously you've taken a long path to get here. So I'm curious about what else there is that you've enjoyed.
Yeah. I'd say there's a few, real estate based assets that I've utilized. There's also, commodities. So oil and gas, investing in oil and gas. Anytime you invest directly into oil and gas, that, when you have gains or losses, that is actually considered active income. So losses associated with oil and gas, opportunities directly offset your active. So if you're a W-2 employee or if you have your own business, they offset your active income. But just the concepts of, tax advantage of investments, really, what I look for is something with depreciation. Depreciation is single-handedly, in my mind, the strongest, tax advantage component of the tax code. So I look for things that allow me to take advantage of depreciation. When as an investor, I'm earning cash returns for properties, but the tax is actually deferred that on that associated cash because of the fact that I invest in assets that depreciate. It means, basically you're not required to pay tax on earnings from an asset until it's sold. And unlike other investment vehicles like stocks and mutual fund earnings. And so, there's that. And then there's also the power of the 1031, something called the 1031 exchange for those listeners that aren't familiar. Not only are real estate assets tax advantaged from depreciation perspective, but once you do have to recapture that depreciation upon sale of a property, you can still defer your gain by investing in something that has equal or more value and putting your capital into that second property. And, that just allows you to, a lot of people don't stop and think, it allows you to have more control over your capital, and it allows you to have more access to being able to grow that capital because you're deferring the tax hit. You might have made, $200,000 on an investment, but it allows you to defer that tax hit and take that gross amount and reinvest it elsewhere. So the IRS wants to stimulate further investment. It wants to stimulate businesses and things like that. So those are some of the best, components of the tax code itself. And the other thing that I always tell people to do as well is to make sure that you're offsetting capital gains with losses. So just timing your overall investments. So capital gains from real estate that are offset by losses when you do your tax planning, those are critical components to building wealth. The key is to manage your investments so that you have both passive income and passive losses from things like depreciation, like I talked about.
Mm-hmm.
And so that's where like working with a good accountant is really key. Basically you want to make sure that they're looking at everything within your portfolio before the end of the year so that they know the timing of what's transpiring. And if you need to try to find some additional depreciation to offset capital gains if you sold a property.
Yeah. I mean, that sounds incredible to me. Yeah, I mean, it's become very clear to me that there are a lot of these avenues to make money while not having to pay taxes on it, which was not something that I knew existed even 3 years ago. I'm relatively young, and it's just not the kind of stuff that they teach you in school. It's not the kind of stuff that you learn about until you really go out of your way to. So for that, I'm very appreciative of guests like you who are here to teach me and our listeners about it. So thank you for that.
Yeah. And when you think about taxes as the biggest expense that you incur as an American, you start to reframe the way you think about investing and, everything that you do, basically, because you start thinking about your investments and everything else that transpires in your life from an after-tax perspective. Mm-hmm. So that's one reason why I wanted to jump into real estate is compared to the market, which I invest in as well. It's just that, I look at all of the gains on my portfolio from an after-tax perspective. It's ingrained in my brain, unfortunately.
I don't think it's that unfortunate, if I'm being honest. It sounds like it served you pretty well. So finally, before I let you tell all of our listeners where to find you and plug anything that you would like to, I like asking this question to all of my guests, and that is, what does financial freedom mean to you?
I like it. So financial freedom means to me the ability to work from wherever, location freedom. Not having to, necessarily go into a particular location to work and having the ability to travel and live and work wherever you see fit. Another thing for me would be time freedom. So being able to make my own schedule and focus on things that are most important to me and that I'm passionate about. And then probably the most important one to me is the ability to focus on your sphere of influence. And so what I mean by that is having the freedom to focus on spending time with people and reviewing resources that allow me to meet my personal, financial, and my business goals. I have a few examples I can think of in that, just surrounding yourself with people who have successfully pursued the goals that I have for myself. I do so with surrounding myself with other investors, entrepreneurs, and other people in my network that have accomplished the goals that I have. I'm a real estate investor, an angel investor, and a member of masterminds and things like that. And I strive to never be the smartest person in the room, so that I can continue to facilitate my own growth.
I couldn't agree more about not being the smartest person in the room. Very similar to the ideals of, learning more from failure. I think surrounding yourself with the right people and people that are smarter than you is the best way to learn. So couldn't agree more. So please tell the listeners where they can find you, and feel free to promote anything you'd like to. Sure.
So you can find me at onestreetcapital.com. You can email me, Denise, and that's DENISE at one, and it's ONE street, no S, capital.com. Please feel free to reach out. I'm happy to help anyone on their journey to investing in alternative assets. Happy to share my experiences. And I know I also mentioned the tool that I had written based on my experience, the 50 questions to ask before you passively invest. And so if you go to our website, again, it's capital.com, you can actually download that for free. So happy to share that with anyone who wants to see it.
It's a fantastic read, I can say so, from experience.
Thank you so much.
Of course. And so thank you so much, Denise, for coming on. I had a wonderful time talking to you, and I hope we can talk again soon.
Absolutely.
So on behalf of myself, on behalf of Denise, and on behalf of Camaplan, thank you so much for listening, and I look forward to talking to you next time.